The global silver market operates on a measurable imbalance that has persisted for decades. Annual industrial consumption has exceeded primary mine supply in most of the last 15 years, while price discovery has remained anchored to paper settlement mechanisms rather than physical delivery ratios. At the same time, reported inventories at major Western exchanges have declined in absolute terms, even as notional trading volume has expanded. This analysis reconstructs how a specific intake pattern altered that equilibrium, and why the system's response reveals more than the headline numbers suggest. For most observers, silver appears to move within a familiar administrative routine. Contracts are listed, positions are rolled, deliveries are netted, and settlement statistics are published on schedule. The process appears orderly, repetitive, and largely immune to abrupt structural change. Even periods of volatility tend to resolve into the same procedural cadence, reinforcing the perception that the system absorbs shocks without altering its internal logic. From the outside, silver looks like a market defined by continuity rather than rupture. This perception is reinforced by institutional language. Exchange reports emphasize open interest, warehouse classifications, and margin compliance. Central bank commentary, when it exists at all, frames silver as an industrial input rather than a monetary variable. Trade data is aggregated into broad categories that obscure destination-specific behavior. In this environment, change is rarely presented as change. It is presented as variation within tolerance. What often goes unnoticed is that this tolerance is not infinite. It is conditional. It depends on a balance between contractual obligations and physical availability, and on the assumption that most participants will continue to prefer financial settlement over metal movement. As long as those preferences hold, the system functions with remarkable efficiency. When they begin to shift, the signals are subtle, delayed, and frequently misinterpreted. Over the last several years, one of those signals has emerged not through price spikes or public declarations, but through accumulation patterns embedded in trade and settlement data. These patterns did not announce themselves as disruptive. They appeared at first as incremental increases in import volumes and refining throughput. They were treated as routine adjustments to industrial demand. Yet when examined in aggregate and over time, they formed a trajectory that intersected directly with the limits of existing settlement infrastructure. The question is not whether silver demand increased. That has happened before. The question is whether a specific intake crossed a threshold beyond which existing settlement assumptions could no longer be maintained without structural adaptation. This is not a question about intent or strategy. It is a question about mechanics. At what point does sustained physical intake by a single system cease to be absorbed by global inventories and begin to redefine how settlement must occur? Before addressing that question, it is necessary to establish clear limits on scope. This report does not project prices, recommend actions, or attribute motives. It relies exclusively on publicly available data, documented market structures, and observable flows. Where interpretation is required, it is constrained by arithmetic and process, not speculation. The objective is to examine how a documented event interacts with an existing system, not to predict outcomes beyond what the system itself permits. The event anchoring this analysis occurred quietly, without a single defining headline. It unfolded through a series of trade disclosures, customs records, and exchange inventory reports that, taken individually, appeared unremarkable. Taken together, they revealed a change in scale. Over a defined settlement period, net silver inflows into China exceeded not only its recent historical averages, but also the net deliverable surplus available through Western-facing exchanges for the same interval. This was not a matter of annual demand surpassing mine supply, a condition already familiar. It was a matter of intake relative to settlement capacity. Silver entering China during this window did so through multiple channels. Direct imports of refined metal, increased drawdown from bonded warehouses, and accelerated conversion of semi-fabricated forms into domestically held bullion. Each channel is documented separately in trade statistics. What is less commonly examined is their combined effect on the global pool of silver that remains eligible for rapid exchange settlement elsewhere. At the same time, reported eligible inventories at major exchanges continued to decline or stagnate, even as registered stocks used for delivery fluctuated within a narrowing band. The distinction between eligible and registered silver is procedural, but the ratio between them is structural. It reflects how much metal exists within the system versus how much is actively pledged to settle contracts. As China's intake increased, this ratio tightened, not catastrophically and not uniformly across all reporting periods, but persistently. The system responded not by defaulting, but by adapting in ways that preserved formal compliance while reducing optionality. Contracts were rolled forward at higher rates. Physical delivery requests remained a minority of total positions, but those that did request delivery increasingly did so over extended timelines. Premiums in certain regional markets diverged modestly from exchange benchmarks, then normalized, then diverged again. None of these developments in isolation constituted a breach. Together, they mapped the boundary conditions of the settlement framework. The critical detail is not the absolute tonnage imported, but its relationship to what could have been delivered without altering behavior elsewhere. When intake reaches a level that requires either accelerated mine supply, reallocation from existing holders, or increased reliance on deferred settlement, the system must choose among those options. Each choice carries implications that are visible, even if understated. In this case, mine supply did not accelerate meaningfully. Production growth remained constrained by geological, regulatory, and capital factors. Reallocation from existing holders occurred only at the margins, reflected in sporadic inventory draws and lease rate fluctuations. The primary adjustment occurred in settlement behavior. This is where the notion of a settlement threshold becomes relevant. A threshold is not a fixed number. It is a functional boundary at which the marginal unit of demand cannot be satisfied through existing routines without changing those routines. When that boundary is crossed, continuity is maintained through adaptation, not through expansion. China's silver intake during this period intersected that boundary, not because it consumed all available silver, but because it absorbed enough of the deliverable margin to make the remaining buffer operationally significant. The system could still settle. It could still clear contracts. But it could no longer do so while assuming that physical demand would remain subordinate to paper preference. This shift did not require an announcement. It required only persistence. The implications of this persistence extend beyond the immediate event. They invite a reassessment of how silver functions within a global system increasingly divided between financial abstraction and material consolidation. They also raise questions about how long-standing assumptions about liquidity and availability are maintained when major participants prioritize custody over circulation. These questions do not resolve themselves quickly. They unfold over cycles, reporting periods, and behavioral adjustments. The remainder of this analysis examines those cycles, beginning with the historical context that produced the current settlement architecture and moving through the structural stages that define its limits. To understand why the settlement threshold mattered, it is necessary to step backward into the historical architecture that shaped the modern silver system. Silver has occupied a dual role for centuries, functioning simultaneously as an industrial input and a monetary reserve. The tension between these roles has never been fully resolved. Instead, it has been managed through institutional layering, with each era introducing mechanisms designed to contain scarcity without eliminating it. In the late 19th and early 20th centuries, silver's monetary role was gradually subordinated to gold-based systems. This transition did not remove silver from circulation, it repositioned it. Silver became a secondary monetary asset and a primary industrial metal. The consequence of this shift was structural. Monetary demand became episodic and political, while industrial demand became continuous and elastic. The system that emerged was one in which long-term accumulation could occur quietly, without triggering immediate price or policy responses. The post-war period intensified this separation. As industrialization accelerated across multiple regions, silver consumption diversified into electronics, chemical processes, photography, and later photovoltaic applications. At the same time, Western financial systems consolidated control over price discovery through centralized exchanges and derivative instruments. These exchanges did not require physical scarcity to function. They required confidence in netting, rollover, and deferred delivery. This confidence was justified for decades. Mine supply, recycling, and above-ground stocks were sufficient to accommodate incremental growth in demand. More importantly, most participants preferred exposure rather than possession. Silver became something to be traded, hedged, or referenced rather than moved. China's position within this system evolved gradually. During the early phases of its industrial expansion, silver imports tracked manufacturing output and export growth. The metal flowed in, was consumed, and exited indirectly through finished goods. This pattern did not challenge global settlement norms because it did not alter custody dynamics. Silver entered China, but it did not accumulate there at scale. That pattern began to change as China's industrial base matured. Domestic refining capacity expanded. Strategic stockpiling practices developed across multiple commodities. Supply chains shortened and reliance on external intermediaries declined. Silver increasingly entered China not as a transient input, but as a retained asset within an integrated production ecosystem. Historically, this distinction mattered. Systems designed for throughput behave differently when confronted with retention. When metal circulates, inventories replenish. When metal consolidates, inventories thin. The global silver system was calibrated for circulation. The settlement infrastructure reflected this calibration. Futures exchanges operated on the assumption that only a small percentage of contracts would result in physical delivery. Warehouse systems were structured to classify metal as eligible or registered, allowing flexibility without requiring full backing. This structure was not deceptive, it was functional. It optimized liquidity. However, liquidity is context dependent. It depends on the willingness of participants to accept substitution. Cash instead of metal, later instead of now, paper instead of physical. When a large participant consistently chooses physical intake over financial substitution, liquidity becomes a variable rather than a constant. This is the context in which China's intake must be situated. It was not merely an increase in demand, it was a shift in behavior. Silver was being removed from the pool of metal that could easily re-enter Western settlement channels. Once refined, bonded, and integrated into domestic systems, it ceased to be available for rapid redeployment. The structural stages of this process can be observed sequentially. In the initial stage, increased imports are absorbed without visible disruption. Inventories decline modestly, but remain within historical ranges. Prices remain stable. Settlement statistics show continuity. In the next stage, divergence appears. Regional premiums begin to decouple intermittently from benchmark prices. Lease rates fluctuate. Delivery timelines extend slightly. None of these signals are definitive on their own. They are often dismissed as noise. The third stage involves behavioral adjustment by intermediaries. Traders increase reliance on rolling contracts. Physical delivery requests are discouraged through pricing differentials or logistical delays. Exchanges emphasize compliance and margin integrity, reinforcing confidence in the paper system, even as physical optionality narrows. Throughout these stages, the system continues to function. There is no failure. What changes is resilience. The buffer that absorbs shocks becomes thinner. China's intake crossed into this third stage during the settlement window examined in this analysis. The volume absorbed did not exhaust global supply. It reduced the margin within which the system could pretend that physical demand was irrelevant to settlement mechanics. At this point, the system's response is governed by constraints rather than choices. Silver cannot be created on demand. Recycling responds to price signals, but with delays. Mine development operates on multi-year timelines. The only adjustable variable in the short term is settlement behavior. This leads to a structural convergence. Physical scarcity does not need to be absolute to exert influence. It only needs to be sufficient to constrain flexibility. When that occurs, the system increasingly relies on abstraction to maintain continuity. The mathematics underlying this reliance are straightforward. If total open interest represents a multiple of deliverable supply, and if only a fraction of participants ever demand delivery, the system remains stable as long as that fraction remains predictable. When a new source of sustained physical demand enters the equation, predictability declines. China's intake altered the denominator, not the numerator. Open interest could expand or contract independently. What changed was the amount of silver available to satisfy unexpected delivery requests without cascading adjustments. This is why the concept of inevitability applies. Once intake patterns reach a certain scale, reversal is not immediate. Industrial systems are not easily downsized. Stockpiles, once accumulated, are not casually released. The system moves forward with altered parameters. The base mathematics of supply and demand do not require dramatic assumptions to illustrate this. Annual mine production, recycling flows, and documented industrial consumption already operate near balance. The margin that supports investment demand and settlement optionality is comparatively small. When a portion of that margin is persistently absorbed, the remaining system must adapt. Adaptation does not imply collapse, it implies reconfiguration. Exchanges may adjust contract specifications. Delivery rules may be refined. Settlement incentives may shift. None of these changes need to be announced as responses to a single participant's behavior. They emerge as administrative refinements. What matters is that the system, once adjusted, does not return to its previous state unless the underlying behavior changes. If China's intake stabilizes at a higher plateau, the settlement architecture will incorporate that reality permanently. This sets the stage for the mathematical examination that follows. The question is no longer whether silver is scarce in absolute terms. It is whether the system, as structured, can simultaneously accommodate sustained physical consolidation and expansive financial representation without internal contradiction. The next phase of this analysis turns to that arithmetic directly, examining the constraints imposed by production rates, inventory classifications, and settlement ratios. It is within those constraints that the limits of flexibility become visible. As the system advances beyond the initial stages of adjustment, the dynamics governing silver settlement converge toward a narrower set of outcomes. This convergence is not driven by intent, coordination, or declaration. It is driven by arithmetic interacting with institutional design. When physical consolidation persists while financial representation remains expansive, the system's degrees of freedom contract. In advanced stages, the distinction between flexibility and fragility becomes increasingly procedural. The system still clears. Contracts are honored. Reports are published. What changes is how much discretion remains at the margins. Each additional unit of metal removed from the deliverable pool reduces optionality disproportionately because it subtracts from the buffer rather than from the core. This is where convergence occurs. The silver system does not bifurcate into separate regimes overnight. Instead, it compresses. Settlement timelines extend, contract structures evolve to favor cash equivalents, physical delivery becomes more formalized, less spontaneous, and increasingly mediated by administrative thresholds rather than participant preference. In this phase, inventory classifications take on heightened importance. The difference between metal that exists within a warehouse system and metal that is pledged for delivery becomes a central organizing principle. Movement between these classifications slows, not because of rules, but because of incentives. When metal is scarce relative to claims, holders are less inclined to reclassify without compensation. The system adapts by reinforcing abstraction. Paper representation continues to expand because it fulfills economic functions unrelated to immediate physical exchange. Hedging, accounting, and exposure management all benefit from continuity. The cost of this continuity is a growing reliance on the assumption that most participants will never test the boundary conditions. The mathematics of this assumption are increasingly visible. At any given time, the ratio of outstanding claims to deliverable metal exceeds unity by an order of magnitude. This ratio is sustainable only if delivery demand remains statistically bounded. Persistent physical intake by a large participant alters that distribution, not by increasing claims, but by reducing the pool that can satisfy variance. This leads to a closure problem. If a system requires optionality to function smoothly, and optionality is consumed by consolidation, the system must substitute certainty for flexibility. Certainty takes the form of rules, schedules, and equivalence mechanisms. These mechanisms preserve order, but they also formalize limits. The closing arithmetic does not imply a sudden impossibility of settlement. It implies that settlement increasingly occurs under constrained pathways. Cash becomes the default resolution. Physical movement becomes planned rather than responsive. The system still closes its books, but it does so by narrowing acceptable outcomes. This narrowing is the mathematical endpoint of the process initiated by sustained intake. It is not reversible through short-term measures. Production cannot scale rapidly enough to restore prior buffers. Recycling responds slowly and unevenly. Existing stockpiles, once integrated into domestic systems, do not re-enter global circulation without structural change. As a result, the future unfolds not as a singular event, but as a sequence of administrative adaptations. Over the near term, exchanges emphasize stability. Reporting remains consistent. Volatility is managed through margin and position limits. The system communicates continuity. Over the medium term, structural refinements accumulate. Contract terms are adjusted. Delivery incentives are recalibrated. Market participants internalize new norms regarding what is feasible and what is merely theoretical. None of these changes are framed as responses to scarcity. They are framed as efficiency improvements. Over the longer term, the distinction between financial silver and physical silver becomes more pronounced in practice, even if not in language. Access to metal is mediated by process rather than price alone. Physical settlement becomes a specialized function rather than a background option. This timeline does not require prediction to be useful. It provides a framework for observation. Each reporting period, inventory update, and settlement cycle becomes a data point in a longer sequence. The system reveals its trajectory through what it normalizes. It is important to acknowledge risks and counterpoints within this framework. Silver demand is not monolithic. Technological substitution can alter consumption patterns. Economic contraction can reduce industrial throughput. Policy changes can influence trade flows. Any of these factors could moderate intake over time. Additionally, financial systems are adaptive. New sources of liquidity can emerge. Contract innovation can redistribute risk. Transparency improvements can alter participant behavior. These countervailing forces do not invalidate the structural model. They interact with it. What they cannot change is the arithmetic. Claims cannot exceed deliverable supply indefinitely without redefining what delivery means. When physical metal is consolidated outside the settlement loop, the loop adjusts inward. The credibility of this analysis rests on its limits. It does not assert motive. It does not forecast price. It does not declare resolution. It documents a process that has crossed a functional boundary and continues to evolve within constrained parameters. The point of no return in this context is not a moment of failure. It is a moment of commitment. Once the system commits to adaptation rather than expansion, its future behavior becomes path-dependent. Each adjustment builds on the last. Monitoring this process requires attention to mundane details rather than dramatic signals. Inventory classifications, delivery notices, contract amendments, and trade statistics provide more insight than headlines. The system speaks through procedure. This report ends where observation continues. The silver system remains operational. Settlement continues. What has changed is the margin within which it operates. Understanding that margin is essential to understanding everything that follows.